If you ask 10 people what investment strategy means, most would describe picking stocks, chasing a hot fund, or timing the market. Almost none of them would say that the real answer is how you divide your money across asset classes and across time horizons in the first place. That decision, not stock picking, is what actually drives most of your long-term results. It's easy thing to overlook this because it's not exciting. Nobody brags at a dinner party about their asset allocation in the way that they brag about a stock that's certainly doubled. But the boring decision is usually the one doing most of the work behind the scenes. Today, we're breaking down why that one decision, how you divide your money, matters more than almost anything else you'll do as an investor. Welcome to On Course Financial, Charting Your Financial Future. I'm Chris Brumlow, partner with the BAB Group, financial professional, investment advisor representative, and a financial retirement planning specialist. The BAB Group is a proactive wealth management, accounting, and tax firm serving individuals and small business owners. Our goal isn't just to hand you the numbers. It's to help you understand them, connect to them, understand how that relates to real decisions, and use them to plan for the future instead of just reacting to the past. That's what today's episode is all about. Why asset allocation should come first. Strategic asset allocation is the primary driver of long-term performance. Before you ever pick an individual investment, the mix of stocks, bonds, cash, and other assets you hold does more to determine your outcome than almost any other single decision. Diversifying across asset classes, sectors, geographies, and managers helps reduce volatility and manage risk, even if it means giving up some upside in a single year. That last part trips people up. A well-diversified portfolio will, by design, never have your single best performing investment as its whole story. That's not a flaw, that's the point. Here's what it looks like in practice. Say a particular sector has a huge run for a couple of years. Technology, energy, it doesn't matter really which one. Someone watching it from the sidelines starts to feel like they're missing out and moves to a much bigger share of their portfolio into that sector in an area to chase the return. And for a while, that might even work. But concentrating into whatever just performed best is also concentrating your risk into whatever is most likely to be overextended. Greed and fear. A diversified allocation will rarely be the single best story in the room on any given year. But it's built to be standing in reasonable shape no matter which story turns out to be the calendar year's cautionary tale. This is really about how different pieces move in relation to each other. Stocks, bonds, real estate, and cash don't all rise and fall together. They tend to respond differently to the same economic conditions. When stocks are struggling, bonds often have held up better, and vice versa. Blending asset classes that don't move in lockstep is what it actually is about. It's what smooths out the ride. Even though no single piece of that blend is ever the star of the show by itself. Allocation isn't static. So once you've built a genuine diversified mix, the next question is whether that mix should stay the same forever. It shouldn't. Your allocation should reflect your goals, your time horizons, and your risk tolerance, not what the market did last quarter. Those three things, goals, time horizon, and risk tolerance, are personal to you, which is exactly why there's no single right allocation that applies to everyone equally. A business owner with most of their net worth tied up in the business often needs a more conservative allocation in their outside investments, not a more aggressive one. And that surprises people. The instinct is often, I'm comfortable with risk, so my whole portfolio should be aggressive. But if the business itself is already in a concentrated high-risk asset, piling more risk on top of that in your investment accounts just doubles down on the same exposure instead of balancing it out. As you move from accumulation into retirement, the mix should often shift to reflect that you're no longer just growing the pool. You're drawing income from it. And that usually means layering in more stability, a larger allocation to bonds or asset classes that have some more stability or income producing. cash equivalents that can fund near-term withdrawals, so you're not forced to sell growth assets at a bad time just to cover this month's expenses. Rebalancing back to your target allocation is what keeps buy low, sell high from being a slogan and makes it into an actual mechanical habit. When one asset class grows faster than the rest, rebalancing means trimming some of that winner and adding to what's lagged, which in practice is buying low and selling high, almost automatically without having to guess where the market goes next. Why chasing last year's winner backfires? This is worth its own moment because it's one of the most common mistakes we see. Most large, liquid markets already reflect the available information fairly efficiently, which means by the time an assets class great run is obvious enough to chase, a meaningful part of that run has often already happened. Piling in after the fact isn't catching the trend. It's usually arriving closer to the end of it. There's also a behavioral piece here. Watching a diversified portfolio during a year when one asset class is soaring can feel frustrating, like you're being held back on purpose. But that same diversification is what prevented the portfolio from being wiped out the last time that hot asset and that hot asset class cooled off hard. Simplicity and transparency win over time, precisely because they help you stay in the plan during the years that it doesn't feel exciting. And staying in the plan is most of what makes it work. Think about how this plays out over a full market cycle rather than a single year. Whatever asset class is having its moment always eventually cools off, and whichever one looked boring tends to have its own moments later. An investor who keeps reshuffling into whatever one ends up perpetually buying late and selling out late, chasing a story that's already mostly told. An investor who stays diversified and rebalances on schedule ends up almost by accident doing just the opposite, trimming what's expensive and adding to what's cheap over and over again without ever needing to correct, predict, or chase which asset classes turn is next. You're putting a number on rebalancing. Let's make rebalancing concrete instead of abstract. Say someone starts the year with a target allocation of 60% in stocks and 40% in bonds. Stocks have a strong year and bonds are flat. And by year's end, that same portfolio has drifted to somewhat closer to 70% stocks and 30% bonds without the investor doing anything at all. Left alone, that portfolio is now taking on meaningfully more risk than it was designed for, simply because one piece grew faster than the other. Rebalancing means selling enough of that stock position and adding to the bond position to get it back to the original 60-40. It can feel counterintuitive in the moment. You're trimming the thing that just did well. But that's exactly the discipline that locks in some of the gains and keeps the portfolio aligned with the risk level that was actually chosen on purpose, rather than the risk level that the market happened to drive it into. Let's take a look at a practical example. Picture two clients with the identical portfolios on paper, the same total balance, the same broad allocation. One is 35 and building a business, and the other is 63 and 2 years from retirement. If both are invested the exact same way, one of them is taking on far more risk than their situation calls for. The 35-year-old has decades for the market to recover from any downturn, and their business is where most of their real financial risk already lives. So a more growth-oriented allocation in their investment accounts may make sense as a genuine diversifier. The 63-year-old, 2 years out from drawing income out of that same portfolio, doesn't have decades to wait out a bad stretch. A market drop right before retirement without enough stability built into the portfolio can permanently sink the income that portfolio was supposed to provide. Same balance, same broad allocation on paper, but two completely different levels of appropriate risk. If the 63-year-old's allocation had been reviewed and adjusted well before the 2-year mark, a market downturn on the way to retirement would just be a bump in the road instead of a crisis that reshapes the rest of their income plan and retirement years. Allocation isn't about a number that you set once. It's a decision that you revisit as your life changes. Let's have some takeaways. If there's one number worth knowing cold, it's this one. Know your current allocation. not just your account balances, but what's actually inside them. Two accounts with the same dollar amount can be allocated completely differently. Revisiting your allocation anytime your circumstances change materially, a business sale, a new dependent, an approaching retirement date. These are the moments an old allocation stops fitting their life that it was supposed to support. Don't confuse a good year for one asset class with evidence that your whole portfolio should chase you. A strong run is information. It's not instruction. Rebalancing on a schedule, not a hunch, removes the emotion from the process. And emotion is usually what causes investors to buy high and sell low instead of the other way around. If you're a business owner, treat your business as part of your overall allocation, not something that's separate from it. Concentrated risk doesn't disappear because you're sitting in a business instead of a brokerage account. So let's wrap this episode up. If you've never actually looked at your allocation as a whole across every account, not just the one you check the most, it's a worthwhile conversation to have before you make any other investment decisions this year. It's less exciting than a conversation about picking the next great stock, but it's very likely an important one. That's it for today's episode of On Course Financial. If this helped clarify something you've been wrestling with, share it with someone who needs to hear it. Like and subscribe to our channel, and we'll see you next time. Until then, stay on course. Investment advisory services are offered through Alphastar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute endorsement by the firm or the commission, nor does it indicate that an advisor has attained any particular level of skill or ability. Alphastar Capital Management, LLC, and the BAB Group are separate and independent companies. The information shared in this episode is for general information purposes only and not intended as legal, tax, or investment advice or a recommendation of any particular security.